I'm just pushing it a little further in the sense that you were in the finance ministry before you took up this job. Do you see, there's always the complaint that private investment really didn't, and that's the government's complaint, not yours, that private investment really didn't live up to what it should have done after the huge rates in their income tax, corporate tax rates and everything else. Do you see that change now? Is that what you're referring to when you say private investment is up, and is that sufficient to propel growth?
Yeah, so see, as I mentioned, gross fixed capital formation last 4 years as GDP has grown by about 8%, even the capital formation has grown by about 8%. The private sector over there, as you are saying, as you have mentioned, has impeded that. I mean, it could have been much more, as you are saying, but as I mentioned, it is demand which will lead to investment and not the other way around. And with consumption continuously, growing at a fast pace, I'm quite confident that investment will further, private investment, will further grow up. Let's also keep in mind 2 or 3 things with regard to private investment. One, capital intensity, of our economy is actually decreasing because capital is becoming more productive, number one, more efficient. And number 2, there is a shift of the composition of our economy towards services sector, which is growing and which is less capital intensive. So the growths in investment, private investment will not be as high as they used to be earlier. Number 2, some of the sectors that earlier used to witness capex, they themselves as a result of this are changing. If you look at power sector, for example, we were in a deficit situation. So to meet the deficit, obviously the capital requirements would have been much more. Yeah. We are now, more or less in a self-sufficient, position, having met all the deficit. So the growth in investment is not going to be, as high in those sectors. On the other hand, you see higher growth in investment in some of the new sectors, renewable energy for one, defense equipments. Now, there's a push by the government on defense equipment, electronics, semiconductors, mobile phones. So there is a shift in terms of the sectors that we normally would have otherwise tracked for private investment. So all these things, and given the fact, that as I mentioned earlier, good capacity utilization, very healthy balance sheets of the corporates, they are poised, and similarly, the good balance sheets of the banks who are eager to lend more and more to the real economy. I think all of these augur very well going forward for private investment.
Since my colleague N.G. Arun mentioned exporters, one of the things is the currency issue. And the rupee has crossed 90 to the dollar, and yet the RBI, unlike in the past, is in no rush to aggressively defend a specific level of the rupee. At the same time, the weaker rupee, as we have been talking about, has cushioned exporters and import competing industries amid rising US tariffs. It doesn't seem to be getting any relief on that. Is the RBI consciously allowing greater exchange rate flexibility? How do you balance competitiveness with imported inflation and financial stability?
Yeah, so on currency, you see, we have a very stable stated policy that we do not target any level or any price band, and we let the market forces, which we believe are quite deep, to determine what the appropriate level of the rupee should be vis-a-vis, whether it is the dollar or the pound or the euro or any other foreign currency. Our aim over there is primarily to curb any kind of an undue or excessive or an abnormal kind of a volatility which we try to curb, or if there is some kind of unnecessary speculation which is getting built into the prices, then we come in. Otherwise, we let the market forces determine the prices, which in the long run we believe are quite efficient. The market is quite efficient, and so even in this round, while some currency depreciation may help exporters, the primary purpose is, it's not that we have made a conscious effort to let the rupee depreciate.
And why I asked you that, because if you see what happened the previous 4 years, I think close to 2% of the GDP was spent on shoring up the rupee and keeping it at a rate that the RBI and the government thought was fine to help India. So should Indians now get used to a structurally weaker rupee? Is that the policy going ahead, that look, we're not going to intervene, barring, as you said, major fluctuations, but generally we believe that that's the direction we should be heading to?
I don't think, first of all, I don't think there is any major change
Right.
in the policy of the RBI to intervene. As I mentioned earlier, the policy has been very stable over the last few years, and it's only undue excessive volatility that we try to reduce. Secondly, as to what levels the Indian economy should be prepared for. See, over the years, I think there is this volatility which will continue to happen, which we have witnessed even earlier. So it's not something which is new or our economy is not prepared for. I may mention that ECBs are today 76% hedged. So people are already they already factor in and they are prepared for this kind of volatility. Last 10 years, the depreciation has been about 3% on an average. 20 years, it has been about 3.4%. So it has come down. The depreciation on an average has come down, and we believe that even going forward, the depreciation levels should not be significantly different. Maybe it should be on the lower side, given the fact that inflation now in India is going to be lower vis-a-vis the other economies. And why we depreciate is because one of the major reasons thereof is that there is there is a difference in the inflation. While advanced economies like US, they target 2%, we target 4%. We were higher than 4%. As I mentioned, we were 4.9%. So this differential in inflation will, as long as it is there, our currency will depreciate. But going forward, we are quite confident. We have a very robust, strong external sector position. We have 11 months of import cover for goods, as everyone knows, and we are about we have 92% in foreign exchange reserves vis-a-vis our short vis-a-vis our debt, external debt. External debt is about $750 billion US dollars, and we have about $690 billion of foreign exchange reserves. So we are very comfortable in meeting our external sector liabilities, whether it is on the current account, whether it is on the capital account,